Look, we have our index of our 21 Lehman systemic risk indicators, and we put out a report in late September. They're rising at the fastest pace since 2015. But the important thing to remember is so much money has gone into tech. You know, maybe $6 trillion of passive capital has moved into these ETFs. And more importantly than that, the triple B bucket, so in the corporate bond market, there's $2.5 trillion of triple Bs. $2.5 trillion. That's bigger than the entire high yield market. So the rotation here is going to be spectacular, and you want to look at the U.S. consumer staples.
Now, consumer staples have been catching a bit of a bid as of late. On a trailing or on a next 12 months basis, they're actually trading at a premium to the overall market, even a premium to certain parts of technology. Is that something that we're going to see play out again, this kind of big rotation out of growth into value?
It's going to be spectacular. We delivered a speech this week out at Newport Beach at the Inside ETFs conference, and the focus is out of that money that's in passive, you could see $1 trillion move into staples and value, and then out of the money that's in investment grade bonds, that's going to come out of the bond market. So here's the kicker. The staples right now are 7% of the S&P 500 market capitalization. And in previous runs where the global economy hurts the U.S. economy, that number can go up to 10 to 14%. So you're talking about, if you look at 1999, 2000, when that money rushed out of tech, 1999, 2000, staples could be up 30, 40% from here over the next 18 months.
All right, let's talk about the Fed, because they are at the focus for a lot of the conversation about valuations in the market and everything else, the market activity. Does the Fed have it right? Is Jay Powell, as Federal Reserve Chair, aware of the right things to make a call on interest rates going forward?
Well, right now, if you look at the global economy, you look at oil, they're smoking in the dynamite shed. I mean, they're absolutely off base. You've got the global economy. Remember, there's $62 trillion of GDP outside the United States. 18 in. 62 outside, 18 in. We're not on Mars. If we were on Mars, the Fed would be making a sound case. But the global economy, once again, is a global wrecking ball that is the U.S. dollar. We've seen this over and over again. It's going to embarrass the Fed sometime in the next 3 months, and they're going to backtrack, as they did in 2016 and 2015 and 16. They promised us 8 rate hikes. 8. They delivered 2.